My name is Ray.
Hi, this is Michael.
In another episode of Ray's Economics Clue Book. Today, we'll be talking about the Federal Reserve System and its structure and importance. We've basically been centering around the Federal Reserve the last couple of videos, so now let's center directly on it and see what it's all about. So the Federal Reserve is theoretically has oversight from the Federal Reserve System from Congress, and then the Federal Reserve then from its main part branches off into different sections. So the Federal Reserve has a central board of governors. It's basically it makes the Federal Reserve an independent agency from the federal government. So the Federal Reserve is kind of like a quasi-private organization.
Yeah.
The 7 governors are appointed by the president to 14-year terms, and the Fed chair is appointed to a 4-year renewable term,
including the vice chair.
Vice chair. So from the Federal Reserve, we have one of the most, probably the most important and influential branch, the Federal Open Market Committee. The FOMC, or the Federal Open Market Committee, basically dictates federal open market policy, in which the Fed, through, for example, the sale or purchase of, say, treasury bonds, influenced our money supply and subsequently our economy.
Yep.
The Federal Open Market Committee consists of all 7 governors and 5 federal bank chiefs. These bank chiefs come from the 12 regional banks across the nation.
Yep.
12 regional banks. So we have 5 banks from the 12 different banks shuffle through the 12 banks every once period to be a part of FOMC. However, most importantly, the New York bank chief, New York regional bank chief, is always a member of the FOMC, mainly due to the fact that federal open market operations need to come through money center banks, and all these banks all have at least one major center in New York. So through the New York bank chief.
So that's why the New York bank chief is so important. Okay,
yes.
Sometimes New York bank chief is considered as the real chair for the Federal Reserve governors. So the thing is basically the other 4 bank chiefs are rotating.
Shuffled through the 12 regional banks.
Yes, on a rotating basis. So
So the 12 regional banks we see here are basically somewhat based off of population. They basically start from the east and then expand westward.
Yep.
And so we see here New York is obviously the most central, important one. Then we see other ones, for instance, Boston, Philadelphia, DC, and Richmond, Atlanta, and then we see one in San Francisco that covers the most area.
Yeah, San Francisco covers this purple area. Yeah.
And so the Federal Reserve has a lot of impacts. First of all, it impacts the federal funds rate. Basically, it's banking. As banks borrow from each other, the Fed serves as an intermediary of borrowing between banks, and the Fed's federal funds rate basically can dictate or influence how often or how much banks can borrow from each other. Which
basically determine the cost.
Yes.
For the banks to borrow each other. That's very important because it's uncollateralized.
Yes.
And it's usually it's overnight borrowing between the banks and through the Fed. Why is it through the Fed? Because all the banks, they have a reserve deposit account at Federal Reserve. Okay, so it's a bank's bank, right? So basically, Federal Reserve is just adjusting their reserve accounts.
So so of course banks can also borrow from the Fed directly from a discount window for reserve to fit their reserve requirements. So this discount window as they borrow from the bank. From the Fed, this is called the federal discount rate. The discount rate also influences how easily we fill up reserves and our money supply subsequently. And it's typically higher than the federal funds rate, which is around 2.25 to 2.5% as in January 2019, and the federal discount rate is around 3% as of January 2019.
Yeah.
And so the Fed's rates has very large impacts as a benchmark for economic analysis.
Sure.
For instance, we have a TED spread, the Treasury Euro-Dollar spread. The Euro-Dollar basically represents all foreign dollars outside the United States. It's not just based in Europe. It's just a name. And so the TED spread is basically the spread between the 3-month, or the difference between 3-month Treasury bill rates and LIBOR, basically the London Interbank overnight rate. Basically, it shows it's the overnight daily rate between banks internationally as they lend to each other, and this rate can fluctuate wildly because let's say a 9/11 a catastrophic event like 9/11 happens, causes financial panic, then banks would be less likely to loan to each other.
Sure.
And so the LIBOR rate skyrockets, and then during normal circumstances it goes way back down. And so that rate compared to a 3-month Treasury bill rates, which are relatively more stable by a lot, can serve as a very important benchmark to see our risk in global banking systems.
Yeah, right now the LIBOR rate is very important, particularly because LIBOR rate is for example, you have LIBOR rate for euro dollars, you have LIBOR rate for euros, you have LIBOR rate for even for Chinese yuans. Okay, and for most of the euro dollar, which is all of the US dollar outside the United States, right? It could be in China, could it be in Japan, could it be in India or in England or maybe in France. They mostly, not always, mostly trade in the London market.
Yeah.
Okay, that's why we call it tether spread. The thing is, basically, we just want to stress the importance of the Fed rates. For example, federal fund rate, discount rate, they are very important because they are widely considered as risk-free rates.
Yeah.
Okay, for the dollar, for the dollar currency. So basically, from the spread changes, we can see the sentiments in the global banking system. Okay.
And so one last analysis of the federal funds rate and how it fluctuates with our economy. We can see here during our recessions, the federal funds rate skyrockets down towards a low point. And this usually follows a high point in the federal funds rate, which represents our business cycles, basically. As we reach expansion peak. And then as we reach recession, we need to ease the recession by lowering the federal funds rate, making interbank borrowing easier, and subsequently perhaps increasing our money supply, or at least helping our economy and economic spending. The importance of the federal funds rate being lower during recessions is because during recessions we see something called a balance sheet effect. As our asset value decreases, our balance sheet can basically go from positive to negative, which would make many corporations bankrupt, basically. Theoretically. And so what happens is a vicious cycle of deleverage. What happens is, let's say one corporation sells off all their shares of a certain stock. Now the stock, through this massive fire sale, the value decreases, and this decrease in value causes the same balance sheet effect in another corporation whose asset value, since their holding of this stock decreases in value, their overall asset value decreases, and they may also go into a negative balance sheet, which causes them to do the same thing.
It's a vicious cycle.
They sell their stocks, which lowers the price even more, which hurts even more corporations, which sell even more. So we see a fire sale occurrence that has to be eased through the federal funds rate being lowered, or the Federal Reserve basically acting upon the money supply over in the economy to act as a firefighter against these fire sales.
This chart actually show, basically show the importance of the Federal Reserve's rescue efforts, because the balance sheet effect has unintended consequence for other companies, which called, for example, the September 11th, right, 2001. You can see how emergent the Federal fund rate has been reduced. Okay, from 6% almost dive down to 2%. Okay, so it's not just in one meeting, but you can see how quickly it goes down. Okay, and also 2008, the Lehman Brothers collapse. How much from almost 5% to 0, right? But the thing is, you can see in really very short time period, the federal fund rate from a very high place to almost bottom out. Okay, so that means the Federal Reserve, the FOMC, really takes very swift decisions in a very short time period and rescue the market. Okay, it just at least stabilize the market. Okay, provide basically the last resort of the liquidity, right? Okay.
And so for our final clues, basically the Federal Reserve System is the most important arm, arguably, of the the Federal Reserve System's most important arm is the Federal Open Market Committee, made up of 7 board governors and 5 regional governors, always including the New York board governor. And because the Federal Open Market Committee dictates influences our money supply and subsequent economic spending and performance, perhaps, and can also ease against recessions or act against inflationary gaps. And so the Fed's rate is very fundamental. It's almost like a risk-free rate. It's a very stable benchmark for important spreads to measure economic risk. We just mentioned our TED spread, our Treasury Euro-dollar spread.
No, it's not just TED spread. We have a lot more spread, but TED is just one good example.
One of the most fundamental.
To showcase the importance of the Fed rate decision process, right? Okay, so I think that's all about the Federal Reserve's the structure, and we look forward to seeing you next time. Bye bye.